Hi, I'm Jonathan Bays and this is our November investment market update, and hopefully this month is slightly more positive for portfolios than last month. Across the board, equity markets both in Australia and in the States were down around about 6% last month. They were actually a little bit worse during the month, and from top to toe, the Aussie share market was down about 12% in total, so it was pretty ugly. The key driver for the weakness across the board, I think, is largely one thing, and that's interest rates. We've talked on numerous occasions in the last 6 months about rising real interest rates in the US. And so as interest rates in the US started to push higher, it has been brought to bear on equity market performance. Our portfolio was a little bit troubled through October on the equity side, and in fact we were a bit disappointed with performance. We were hoping to outperform, but like a lot of fund managers, some of our mid-cap and small-cap names really got a big drubbing. We think there's some great opportunities in the months ahead in some of those stocks like BWX and Afterpay in particular, but it was a bit of an indifferent month in October on the equity side, but across the broader portfolio we managed to hold in there and do reasonably well because our portfolios have had quite a degree of cash in them in recent months. So after October's falls, the Aussie share market's now down on the year by 1 or 2%, including dividends. And in fact, only the Brazilian and US share markets are actually up year to date, which might surprise a few people. As we look into 2019, both locally and globally, the outlook is getting a little cloudier. And it's certainly hard to call for significant upside in equity markets, but equally too, it's pretty difficult to be an outright bear. At a global level, interest rates are rising, and there's nothing that can change that fact, and that will have an anchoring effect on share market and indeed property and other asset class values. Corporate profit margins might indeed be peaking as well as this movement to nationalism takes over globalization, and we do start seeing wages push higher. Certainly in the United States, full employment is having a real impact on wage growth there, and one of the key risks that we look for in the next 3 to 6 months is perhaps a bout of wage inflation in the United States, which not only will push interest rates higher, but likely have a bearing on corporate profit margins as well. In Australia in 2019, we have the risk, obviously, of a federal election and the uncertainty that brings. We're also likely to have, I think, a bit of a consumer recession, if you will, for want of a worse term, on account of the housing market and the impact that house price weakness there will have on consumer confidence. But ultimately, as we go through the course of 2019 in Australia, whilst it might be a bit mixed on the housing side, we are blessed by a weakness in the Australian dollar, and we're also blessed by some pretty good capital accounts at both a state and federal level, and an ability from governments both locally here in Victoria and in New South Wales, and indeed at a federal level, to spend up big on infrastructure. And I think that might just get us through 2019 without scraping through for recession. So on the equity portfolio front, we had copped a bit of a black eye, if you will, on BWX, sadly, who profit warned about a month ago, and the stocks have fallen about 30 or 40% since we initiated it in portfolios. We feel pretty confident, however, that we've now seen the low point. We've had some meeting time with management, and we feel that the reason for the profit was very much a one-off, and that the underlying business continues to grow at a very good rate. I think on my reckoning the stock's now down at about 10 times earnings, and I think it will continue to grow at north of 10% a year in the next few years. So I actually happen to think at these levels it's a bit of a bargain. We've also been really encouraged by Afterpay's business update, which we got actually in the early couple of days of November, and the rapid rate of growth they've seen in the United States business. I don't buy into concerns that the market seems to continue to have about increased regulation on Afterpay, and I think that once we get a government review out of the way on that, Afterpay shares will continue to perform a lot better than they have in the past couple of months. But the last one is Healthscope, and we saw a revised proposed bid from Brookfield for Healthscope at $2.45, and they've been granted due diligence on the books, and I do think that ultimately this will lead to a confirmed bid on Healthscope. So finally, after 3 or 4 months we've been waiting on that one, it's finally coming through, and I do think again there'll be some smiles on the face of some happy Healthscope shareholders at the end of it all.
I'm Tim Johansson from Qualitas. I'm the Managing Director of Real Estate Financing Group. Qualitas is a real estate investment manager. We've been operating for 10 years, and we have approximately $2 billion of funds under management, and we invest across the capital stack of the real estate market. So the real estate debt market at the moment is undergoing significant change. The market is in total about $280 billion. The banks dominate that market, as opposed to what you see in North America and Europe, where the banks maybe control 40 to 60% of that market. So this provides at the moment significant opportunity for the non-bank sector, and that's arisen because of significant regulatory change, which is causing the banks to lend less into that market at the moment. Qualitas has created the Qualitas Real Estate Income Fund as an alternate investment for investors in the market, and this takes them away from the traditional yields that they get from dividends, and also creates an opportunity to get a higher yield, which is better than what they will get from lower yielding bonds and term deposits at the moment. This fund provides predictable returns to investors because when you provide a commercial loan, you agree the interest rate upfront with the borrower, therefore you have a predictable return that you can rely upon for the term of that loan. So the listed investment trusts will invest into commercial loan portfolios with our borrowers. This will invest in assets like the acquisition of a commercial property, the acquisition of an industrial property, or it could be providing a loan to a developer who's building an apartment block. The interest paid by the borrower forms the basis of the distribution to the investor. The focus of the investment strategy is to create a portfolio of conservative loans, diversified, and providing predictable returns to the investor. We think the combination of income and capital preservation will be attractive to investors such as self-managed retirees. All real estate markets work in cycles. This is happening at the moment in the residential sector. We had a strong period of growth coming out of the GFC, and this resetting of the market now, or normalisation of the market, is typical of what you find in a cycle in real estate. Notwithstanding this adjustment to the market, we're quite happy with the positioning at the moment. We think it's a good opportunity to the market to readjust and reset itself for the next cycle, which we think will occur in the next 12 to 18 months. We have good economic growth at the moment, employment levels are good, and the population is still growing. Vacancy rates in Australia are low. We've got average vacancy rates of maybe 2.5% across Australia. Melbourne's at 1.4%, 1.6%, and Sydney's at 2.6%, 2.8%. So we think those vacancy rates, along with the population growth of around 400,000 a year, does support the continued development of residential property in Australia.